It is Thursday, February 19th, 2026. And if you look at the financial headlines this morning, there is one number that is effectively blotting out the sun.
$190 billion.
190 billion. That is the revenue Walmart posted for just a single quarter.
It's a staggering figure.
Q4 of their 2026 fiscal year, to be exact.
Yeah.
And to put that in perspective for you listening, that is roughly the annual GDP of countries like New Zealand or Hungary,
Right.
generated in just 3 months by a company that started in Arkansas.
But we aren't here just to read a balance sheet today or marvel at the zeros.
No, exactly. We are doing a deep dive into these sources because this report feels less like a retailer updating us on grocery sales and more like a tech giant flexing its muscles. We've got the Q4 transcript, the slide deck, and the official press release right in front of us.
The narrative has shifted completely if you read through these.
Right. And our mission today is to unpack why. Why is the world's largest retailer suddenly talking like a Silicon Valley startup?
Well, it's because this isn't about just stocking shelves anymore. It's about agentic commerce, massive automation, and a fundamental change in who's actually shopping there.
So let's unpack this. We need to understand how they beat Wall Street's expectations by $2 billion. We need to look at what this AI assistant they call Sparky is doing to consumer behavior.
And how a company this old is moving faster than the startups trying to disrupt it.
Exactly. So let's hit the headline numbers first, just to set the stage. Revenue hit $190.66 billion. Wall Street expected $188 billion. So they basically found an extra $2 billion in the couch cushions.
Pretty much, yeah. And their earnings per share, the EPS landed at 74 cents, which was also a slight beat. But if you really want to understand the health of the business, you don't look at what they did, you look at what they say they're going to do.
The guidance.
Right, the guidance is the tell.
So they are projecting sales growth for the next fiscal year of 3.5 to 4.5%, which for a company this massive is moving a lot of merchandise.
It is. But look at the operating income guidance. They expect that to grow 6 to 8%.
Okay, let's pause there. Sales growing at 4%, but profit growing at 8%. That means income is growing effectively twice as fast as sales.
Precisely. And that divergence is the key to this entire deep dive. When profit grows faster than revenue, it means you aren't just selling more stuff.
You are becoming radically more efficient at doing it.
Yes. You're squeezing more margin out of every single transaction.
So they're getting leaner and meaner.
Exactly. But before we get to the how you know the robots and the AI, we really need to talk about the who. Because looking at the demographic data in this transcript, I was honestly surprised.
Yeah, I saw this too. It's almost a tale of two economies living under one roof.
Management was very explicit about this. They noted that the majority of their market share gains this quarter, meaning the new customers they're winning over, are coming from households earning over $100,000 a year.
So the upper middle class is driving the growth at a discount retailer. That feels counterintuitive. Usually when the economy is doing well or people are earning more, they trade up to specialty stores or Whole Foods.
We'll look at the other side of the coin. For the demographic earning under $50,000, the language in the report was stark. They described those wallets as stretched.
Right. They use the phrase living paycheck to paycheck.
Yes. So you have the core customer base struggling, but the wealthier shopper is coming in and offsetting that weakness.
Is that just inflation forcing people to trade down? Like, is the six-figure earner just going there to buy cheap eggs?
That is certainly the catalyst. But the retention data they shared suggests it's not temporary. Management used the term choiceful. High earners are being choiceful. They came for the cheaper groceries, but they're staying for the general merchandise.
Ah.
The report specifically highlighted mid-single-digit growth in fashion.
Fashion. We aren't talking about multi-packs of socks and underwear here.
No actual apparel. Style categories. They've seen growth there for several quarters now. So the old narrative that high earners only go to Walmart for groceries and then run to a department store for clothes, that is breaking down.
So they are becoming a destination for the entire basket.
Exactly.
The entire basket. That phrase keeps popping up in the sources, and I think that concept is the perfect bridge to the most futuristic part of this report. We need to talk about agentic commerce.
The buzzword of 2026.
It really is, but it sounds incredibly jargon-heavy. Agentic commerce, for the listener who hasn't spent the last year buried in tech journals, let's strip that down.
Wow.
How is this different from me just opening an app and searching for toothpaste?
Okay, so think about the last 20 years of the internet. It has been built entirely on search. You have a specific intent, You type a keyword like laundry detergent into a box, you get a list of 10 options, you pick one.
Right. It's manual. I'm doing the work.
Agentic commerce moves from search to intent.
Meaning the software does the thinking.
It means you give the AI a goal, not a keyword. You tell it, I need to plan a camping trip for 4 people in the Pacific Northwest.
Okay.
And the AI understands what that requires. It doesn't just show you a tent. It builds a whole cart with a tent, 4 sleeping bags, a propane stove, dried food, and bug spray.
And this isn't hypothetical. The transcript shows Walmart has actually operationalized this with Sparky.
Right. Sparky is their AI shopping assistant. And they aren't building this in a vacuum either. They highlighted partnerships with OpenAI and Alphabet to power the backend. But the usage stats are what really blew me away.
Let's hear them.
50% of their app users have already engaged with Sparky.
Okay, but engagement is a slippery metric. I can engage with a chatbot by accident and then close the window because it gave me a stupid answer.
That's completely fair. But the conversion data tells the real story. Customers who use Sparky to build these bundles have an average order value, an AOV, that is roughly 35% higher than those who don't.
Wait, 35%
Yes.
higher? That is a massive delta. I mean, in retail, you usually fight tooth and nail for a 1 or 2% lift. Why is it so high? Is the AI just aggressively upselling you stuff you don't really need?
It's actually less about aggressive upselling and more about reducing cognitive load. If you have to search for 20 individual items for a kid's birthday party, you might forget 3 of them.
Sure.
Or you might just get tired of scrolling through 50 options for paper plates and decide to buy the decorations later in a different store. Friction kills sales.
And the agent removes the friction.
Exactly. It presents the entire solution on a platter. It gives the customer confidence they haven't forgotten anything, so they just hit checkout on a $200 cart instead of a $150 cart.
It's fascinating because it completely reframes the retailer's role. They aren't just a warehouse holding goods anymore. They're effectively a project manager for your household.
That's a great way to put it. It shifts the value proposition from we have the stuff to we know what stuff you need.
But here's the catch. Selling 35% more stuff is great for the top line. But usually getting that much physical inventory to people's doorsteps quickly is a logistical nightmare. And yet this report claims their speed is actually increasing while their costs are being managed.
Which brings us to the logistics revolution. We have to look at the fast delivery metrics. E-commerce grew 27% in the U.S.
Right.
But the subsegment of fast delivery, which they define as under 3 hours, that grew over 60%.
60% in a year. And they claim they can hit 95% of the U.S. population in that under 3-hour window.
That's the stat from the slide deck.
Yeah.
And internationally, it's even wilder. In India, through their Flipkart division, they are doing delivery in under 15 minutes.
15 minutes.
In 30 different cities.
I can't even decide what I want for dinner in 15 minutes. That is incredible speed.
It is.
But how does the math work on that? Traditionally, speed is expensive. You have to pay a courier, you have fuel costs. If I overnight a package right now, I paid a huge premium. How are they not destroying their margins doing this at scale?
That's where the operating income growing faster than sales comes back into play. The answer is nodes.
Nodes.
Yes. They have stopped viewing their 5,200 U.S. stores as just stores. They are now fulfillment nodes. They are utilizing forward-deployed inventory.
Okay, let's unpack forward-deployed inventory for the listener.
Sure. In a traditional e-commerce model from 10 years ago, you order a blender, and it ships from a massive warehouse 3 states away. That takes 2 days and costs a certain amount in shipping.
Right.
In Walmart's new model, the algorithm Sparky knows that the blender is sitting on a shelf in a store 3 miles from your house.
So the delivery distance collapses from 500 miles to 5 miles.
Exactly. And that collapses the cost. But to make that work, the store itself has to be incredibly efficient. You can't have employees running around a massive supercenter confused looking for the blender.
Because that eats up the time you just saved.
Right. And this is where the automation comes in. The transcript described them retiring conveyor belt systems that were 20 or 30 years old.
I noted that visual, too. They said they're replacing them with computer vision and automated palletizers.
It's a complete physical transformation of the back room. 60% of their stores now receive freight from automated distribution centers. And here is the metric that proves it's actually working. Sales grew nearly 5%, but inventory only grew 2.6%.
That is the inventory discipline they kept mentioning on the call.
Right. They are selling more stuff, but they have relatively less stuff sitting idle in warehouses. That is pure efficiency. It means the algorithm is predicting demand so accurately that goods are flowing constantly through the system, not clogging it up.
So we have the AI selling bigger baskets and the automated supply chain delivering them cheaper and faster. But there's a third leg to this stool that I think is actually the most disruptive part of the whole report. It's the hidden business.
The profit mix shift.
Exactly. We tend to think of Walmart as a grocery store. You buy a banana, they make a penny. Maybe 2 pennies. But this quarter, nearly 1/3 of their operating income came from two sources that have absolutely nothing to do with selling bananas.
Ads and memberships.
1/3. That is a huge chunk of the pie.
It is, and you have to understand the margin profile here to see why it matters. Retail margins are razor thin, typically 3 to 5%. Advertising margins can be 70 or 80%.
So every dollar of ad revenue was worth $10 of grocery revenue in terms of pure profit.
Essentially, yes. Their ad business, Walmart Connect, grew 41% in the U.S. Total ad revenue for the year hit $6.4 billion. Global ad business was up 37%.
And this is where the Vizio acquisition fits in, correct? They bought the TV maker last year.
That's the unlock. They mentioned in the call that the Vizio segment drove triple-digit ad growth. By owning the TV hardware that glass in your living room, they now have a direct channel to serve ads to households. They aren't relying on Google or Facebook to reach you anymore. They own the screen.
It's a media network that just happens to sell groceries.
And then you layer on the memberships, Walmart Plus and Sam's Club. Membership income was up more than 15%. In China, Sam's Club membership grew over 35%.
Wow.
When you have a recurring revenue stream from subscriptions, plus a high-margin advertising business, Wall Street stops valuing you like a low-margin grocer and starts valuing you like a high-margin tech platform.
Which perfectly explains the stock buybacks they announced.
$30 billion authorized for share repurchases. You don't spend that kind of money unless management is extremely confident in your future cash flow.
Okay, we have painted a very rosy picture here based on these numbers. 190 billion, AI dominance, robot warehouses. But our job is to impartially report on all the sources, and that means looking at the headwinds. This report couldn't have been entirely perfect. What are the cracks in the armor?
Management was actually quite transparent about the negative sentiment items. There are real headwinds they're facing.
Tariffs were mentioned quite a bit.
Yes, they called it a bumpy environment. Walmart obviously imports a massive amount of general merchandise. If tariffs go up, they either have to eat that cost, which hurts those amazing margins we just talked about, or they pass it to the consumer.
Which risks alienating that lower-income shopper we talked about earlier who is already stretched.
Exactly. It's a tightrope.
They also flagged claims expense. What is that exactly?
It was a specific drag of about 300 basis points in the previous year. It's generally insurance-related, accidents, liability, general risk management. It is improving according to the deck, but it's still a heavy cost center.
And then there is the legislative risk regarding pharmacies. We should make it clear to the listener we aren't taking a political stance here, just reporting what the sources say about the business impact.
Right. They cited maximum fair pricing legislation.
Okay.
New regulations on drug pricing are expected to be a 100 basis point headwind for the full year. The pharmacy business is essentially getting squeezed by the new rules.
I want to ask about one specific risk that everyone in the food industry is obsessed with right now, GLP-1s. The weight loss drugs like Ozempic and Wegovy. If a significant chunk of the population starts eating 20% less food, doesn't that inherently hurt a grocery giant?
It's the elephant in the room for sure. Management was asked this directly on the earnings call, and their answer was nuanced. They basically called it a wash.
Do we believe that based on the data, or is that just corporate spin?
Well, the logic holds up, even if it is optimistic. They argued that while food volume might drop, meaning people are buying fewer bags of chips or less soda, the spend shifts to fresh food. People on these drugs tend to prioritize lean proteins, fresh produce, high-quality nutrition, and pound-for-pound fresh food is much more expensive than processed food.
So the basket size in actual dollars stays the same, even if the calorie count in the basket drops.
That's the theory they are operating under.
Yeah.
And because Walmart sells literally everything, they capture the spend regardless of where it shifts. If you stop buying soda and start buying premium vitamins, they sell both.
That's the ultimate advantage of being the everything store.
Exactly. A specialty snack retailer might get absolutely crushed by GLP-1s. Walmart just reallocates their shelf space.
So let's bring this in for a landing. We are looking at a company that is successfully pivoting from a traditional brick and mortar retailer to a high-tech, automated, media-driven platform. For you listening, whether you are an investor looking at that $30 billion buyback, a tech worker watching AI deployment, or just someone who uses the app to buy groceries, why does this matter right now?
It matters because it signals the end of the search era of commerce. We are witnessing the real-time transition to the agent era. When the biggest company in the world says we are betting our future on AI agents making decisions for consumers, that ripples through the entire global supply chain.
Yeah.
It changes how products are packaged, how they are marketed, and how they are distributed.
It fundamentally changes the definition of shopping.
It does. It moves shopping from an active chore you have to do to a passive approval process.
And that leads me to my final thought for you to chew on today. We talked about Sparky. We talked about how incredibly convenient it is to say, plan my meals for the week and have a box show up at your door 3 hours later. But consider the implication of agentic commerce. If an AI agent is deciding what goes in your cart based on a vague prompt, who is really making the purchasing decisions? Is it you? Or is it the algorithm quietly optimizing for Walmart's inventory levels and their highest margin items?
That is the multi-billion-dollar question.
Because if Sparky knows they have way too many strawberries sitting in the local node, guess what's going to be in your fruit salad recommendation?
Convenience always comes with a trade-off.
It certainly does. That is going to do it for this deep dive into Walmart's Q4. Thank you so much for listening.
Goodbye, everyone.